This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and have a look at how a revaluation of property, plant and equipment impacts our deferred tax calculations. Because what's going to happen is that we are going to revalue an asset under normal property, plant and equipment rules. So you're going to debit the carrying value of the asset, and remember, the credit, the gain, goes to other comprehensive income. So if we go back to earlier within the notes, within your financial statements chapter, remember you've got there your other comprehensive income, and then you have your gain on your non-current asset revaluations. Now, the key bit here in terms of deferred tax is that the tax authorities ignore the revaluation. The tax authorities don't take account of any increase in value until it comes to the final disposal of that item of property, plant and equipment. But that just causes us an issue from an accounting perspective, because that brings in deferred tax. If you think about what deferred tax is the future tax consequences due to a transaction that has occurred in the current year. Well, our transaction is the gain on the property, plant and equipment, and that will give us a future tax consequence, won't it? We will pay more tax in the future. If we're paying more tax in the future, we're going to recognize it now as part of deferred tax, aren't we? So therefore, what we will need to be able to go through and see and calculate is the income tax that we have on that gain, okay? Because previously, any movement that we've had in our deferred tax liability, that will go to profit or loss. But if there is a gain on revaluation of PPE, because that gain has gone to other comprehensive income, any tax upon that gain will also go to other comprehensive income. So it doesn't all go to profit or loss. The tax on the gain will go to OCI, and then any deferred tax in relation to the normal movement, so what would have happened if there was no revaluation, will go to profit or loss. Okay, so it sounds quite tricky. It is a little bit tricky, but we still follow the same steps. 1, 2, 3, 4. Okay, it's when we get to step 4 that's the challenge. Okay, so it wants us to look at the revaluation, the deferred tax upon it in our financial statements for the 31st of December 2015. Okay, so at the start of the year we bought a property for 500,000, so that will have been depreciated, and you can see there that that's been depreciated using whatever rates it may be to $470,000. However, at the end of the year, we've then revalued it to 800,000. So there will therefore be a gain, won't there? As we have revalued it from, is it 470 up to the 800,000. So what we've got there from an IAS 16 perspective is that there is a gain of 330,000 that will go through OCI. Okay. There will therefore then be some deferred tax upon that. But let's work the deferred tax step by step. We're told here that we have the tax written down value at the end of the year of 420. Again, we're not getting you to work it out using some tax rules. It's just being given. So don't worry where that's come from. And then the tax rate is there at 20%, isn't it? Okay. So what we've got there is we can go through now and look at the various steps to go through and work out our deferred tax position, and then more importantly look at the movement, because that's where the challenge arises within a revaluation. So step 1 is to compare the carrying value versus the tax base. So the carrying value is at fair value, and the fair value here is 800,000. $800,000. The tax base that we have, if memory serves me right, was that 420,000. And what that then means is that we have a temporary difference, is it, of 380,000. Step 2 is to go through and take the temporary difference and multiply it by the tax rate to work out your deferred tax position. So here, that's $76,000. Step 3 is to determine whether that is an asset or a liability. So what you have here is the carrying value is greater than the tax base, isn't it? The carrying value at the top there is 800,000. Tax base is 420. So carrying value greater than tax base means that we have a deferred tax liability at 76,000, don't we? Okay. There we go. So should we just take a pause there before we go through and look at step 4? Let's think about the financial statement. So the statement of financial position, the statement of profit or loss, and other comprehensive income. And if we wanted extracts from them, get the easy bits. The property, plant and equipment is there. Was it at 800,000? Okay. You could also, as well, I suppose, include the depreciation. Was it 470, the carrying value? So there must have been 30,000 worth of depreciation. So the 500 less the 470. Okay, I know this wasn't required in the question, but just to give it a bit of completeness. You've then got, is it your deferred tax balance? The deferred tax balance that we've worked out there is 76,000. What would then happen is in the statement of profit or loss, you would then come down to, is it your PBT? And then you would have your tax, wouldn't we? Before you then had, is it your profit for the year? And then what you've got there is your OCI. And then in OCI, you have a gain on revaluation, which was there at $330,000. Okay. Without even thinking about the movement on the deferred tax, we can work out what the tax is upon that gain. The tax is 20%. So that gain of 330 is there at 66,000. So you can then go through that, work out your comprehensive income after tax, and then work out your total comprehensive income by adding together, would it be the profit for the year figure and your figure there. Okay. But there's just one little bit extra that we need to go through and consider when we're looking at, is it step 4? Step 4 is the movement. So we're in the first year of this asset's life. So the deferred tax will have started at 0. So what we have there is that we have an increase in our liability. So we're going to credit the deferred tax liability with the 76,000. Okay. We are then going to debit your tax, but your tax through OCI with, is it the 66,000? And that clearly doesn't balance. So we need to put in a balancing figure. So that balancing figure is a debit to tax through your statement of profit or loss, which I think is that there as 10,000. And that 10,000 represents the normal movement that there would have been on deferred tax if there was no revaluation. Okay, we can prove it. Watch. Because what we've got there is we've worked out the gain. We've said that it was 330, I think it was. We've got the deferred tax in there, was it as 66? But that 66 wasn't all of the movement. Okay. If we had had no revaluation, then to work out the temporary difference, that would have been 470 less the 420, which gives me 50. Okay, so carrying value versus tax base. At 20%, that gives me 10. That 10 is a deferred tax liability. Why is it a deferred tax liability? Because the carrying value is still greater than the tax base. It is an increase in your deferred tax liability as well, because that is an increase from 0 to 10. So I'd have credited my deferred tax liability and debited my statement of profit or loss. And therefore, that 10,000 would have been the movement if there had been no revaluation. Okay, because we'd revalued it by 330, the tax on that 330 has meant that we now have a higher deferred tax liability. So if you so wish, in terms of your tax, assume that there's no other tax. I'm sure there would be within a normal exam question, but you've got there that 10,000 tax expense that's gone through profit or loss. Okay, wow, that's pretty tricky. So if you do see a revaluation, be aware that there may be tax or deferred tax upon it. If there is, focus on the revaluation, get that correct, and then don't worry too much about the revaluation. If you want to get the easier marks with regards to the tax, then just take whatever gain you calculate and multiply it by the 20%, and that will get you some easier marks. But don't let this be the big area that you focus on with regards to the standard on income tax and IAS 12. Focus on the basics. Understand the essentials of deferred tax. And if you can do that, you'll do very well in any exam question.